You are participating in Tax Insight, a little course we put together along with an app and a very thorough book. So our focus here is to teach today about the pitfalls of spending dollars to save dimes. And for some of you, this will be fairly maybe review, and for others, you may have been given some pretty bad advice by a realtor or a loan officer, or perhaps even your very own tax accountant. So this principle that I'm going to teach can be applied to any deduction, but for purposes of illustration, I will apply it to the home interest deduction, since about 70% of our course participants in the pilot group own homes. So let's get started. All right, a little trusty shredder here. Now, my brilliant plan is to always carry a mortgage because I want that valuable mortgage deduction, right? Okay, this is excellent. This is a great strategy. So I will spend the money on the interest and send it to the bank over the course of this year. So January, February, March, April, May, June, July. Come on, July. Come on, bank, take my money. August. School's back in session. September. October. November. And December. The bank wanted to make sure that all of the interest was fully received. Took a little while for it. Sheesh. Okay, so I just sent all of my interest for this home mortgage to the bank over the course of a year. And I feel better about my whole tax situation now, right? Because, well, there's nothing left to do. I just can wait for my savings from the government. Now, while we're waiting, let me explain. Remember when we learned about the marginal tax rate? So that was just in the prior course. That marginal tax rate is how you evaluate the savings of a type of deduction that you're getting, or evaluate the cost of new income that you're earning. And in our situation, you would use your marginal tax rate to compute the value of your deduction. So if I just sent $12,000 to the bank in payment of my mortgage that I'm carrying, then that deduction, which I take, remember our little mnemonic, so say I fought a dragon-toothed canine over lunch, that would be, did I get that right? Yeah, dragon-toothed canine. Yeah, that's right. It works. So that would be fairly easy. You put it on your 1040 and then you would say, well, how much did I save? And that's where you use your marginal tax rate. To compute the savings you get from a deduction, you always take the cost of the deduction, in our case $12,000 over the year, and you multiply it times your marginal tax rate. In our case, a marginal tax rate will be 25%. So 25% times $12,000 gets you $4,000. And that is what we expect to get back from the government. Booyah. Our tax savings has arrived. Sweet. All right, let's see what old Uncle Sam sent us as far as tax savings goes. $3. So I invested or sent the bank my interest payments that I remember specifically shredding 12 of them. My marginal tax rate is 25%, so 25% times 12, right, that's 3. Okay, so there's what I saved. Does that seem like a good deal? No. Does that mean mortgages are bad? Absolutely not. What it means is you just need to think through. If it's an expense that you're already incurring, you take deductions as aggressively as you can. However, you never, ever, ever incur an expense only for the sake of getting the deduction. Make sure the math makes sense. You take the cost of the deduction, multiply it by your marginal tax rate. Your marginal tax rate you can find with the Tax Insight app. You take that, you get your answer, 12,000 times 25%, 3,000. If I'm sending the bank $12,000 every year for interest with a marginal tax rate of 25%, I'm saving myself $3,000 by sending the bank $12,000. That does not make mathematical sense. It needs to make sense in other ways besides for taxes. I think that's pretty much it. Now, one more little thing as far as deductions and credits. A credit is different than a deduction because, remember in our mnemonic, I fought a dragon-toothed canine over lunch. Canine is our credit. That reduces our tax liability dollar for dollar. So, in our situation where, let's pretend that I'm having a transaction with the store, I could say, I'm going to buy this $2,000 thing, and the government has agreed through their tax law that they will credit me back $1,000 or $2,000. It'll cost me $3,000, they'll credit me back $2,000. That's a different story because I'm going to be sending this person purchasing at $3,000. So I give them the 3, and then right when tax season comes around, the government gives me 2 of those back. So the actual after-tax cost of whatever I'm buying was only $1,000. Credits are evaluated differently. They reduce your tax dollar for dollar. Now, if I spend $3,000, that doesn't necessarily mean that the credit is, oh, I get all of that back. You have to understand the rules for that specific credit. Popular ones are the HOPE credit, the education, lifetime learning credit, things like that, where you have to spend so much and then they'll say, okay, well, 20% of what you spent will be a credit. So evaluate that. If you're in a low tax bracket where your marginal tax rate's 10%, then a 20% credit would be fantastic. But if your marginal tax rate is up there at 35%, to spend $10,000 to save $2,000, that's really only getting you a 20% savings. You'd be better to deduct it and save yourself the 35%. So just remember that the difference between a deduction and a credit reduces your tax dollar for dollar. A deduction reduces your tax only by the marginal tax rate times the total cost of the deduction. A little bit of math here, sorry about that, but that's taxes. So thanks for watching, and I look forward to talking with you tomorrow about our next topic. Thanks, guys.